Hello and welcome to Livewire Markets. My name is Chris Conway. Passive investing has long promised low fees, broad market exposure and the elimination of underperformance. But Chris Hesterlo, Senior Investment Specialist from Allan Gray Australia, believes that beneath the surface of this seductive narrative lie serious risks to investors' returns. He joins me today to discuss further. Chris, welcome to Livewire.
Thanks so much for having me, Chris.
Now, Chris, there's a few big structural themes impacting markets at the moment, and at the top of the list, both in Australia and in the US, it seems to be concentration. That concentration in markets, it's creating distortions across a number of dimensions. Now, you argue that investors buying passive funds for diversification are no longer getting what they think they're paying for. That's one of those distortions. So just take us through what you mean by that.
If you're investing in the major benchmarks that are attracting most of the capital today, it sounds like you're getting an incredibly diversified portfolio of equities. If you're investing in the ASX 200 or 300, you're gaining access to the 200 or 300 largest companies in Australia. And if you're allocating to a passive vehicle linked to the MSCI World Index, you're getting exposure to over 1,000 names across the globe. But all of these indices, whether it be the ASX, the MSCI, the FTSE, the S&P, the NASDAQ, they're market cap weighted indices. And what that means is the larger the company, the larger the portion it is of the portfolio. What can happen over time is that if you have a particular style or sector or theme that does very well relative to the rest of the market, that becomes a bigger and bigger portion of the index, and that available diversification decreases. And that's where we think we are today, both domestically and globally. So if we take the domestic side first, the ASX 300, today you have 56%, or at the end of December 2024, you have 56% invested in financials and materials due to the size of the banks and the iron ore miners. Large companies have outperformed relative to smaller companies over the last decade, and you're now putting more money towards the largest top 20 names than you are in the next 280 companies. And by mid last year, you had 12% or almost 12% invested in CBA alone. If you look at the global side, it's really the same painting with different colors. You have 72% invested in the US, and the magnificent 7 tech stocks that we've heard so much about have really grown to have an outsized influence on world markets. You actually have more invested in those 7 stocks, the Mag 7, than you do in the next 7 biggest countries in that index. So investors in these type of very popular benchmarks may think they're getting a lot of diversification, but today they're actually taking some pretty concentrated bets.
Chris, you've talked about some of the other embedded risks in passive investing. So you've just covered off on concentration, but valuation insensitivity is another one. And of course, momentum bias as well, other things that are playing out. So can you just talk to us a little bit about those other two?
Valuation insensitivity simply refers to the fact that the buying decision in a passive approach is being made based on the size of the company, not on any assessment of fundamental value or what you think earnings may do or what the balance sheet may look like. It's simply being driven by size. And that means as long as the price continues to rise for a stock, you're going to continue purchasing as you put new money into a passive approach, no matter how expensive it may get on a fundamental basis. And I mentioned CBA before. I think that's a good example of how these things can happen. By mid last year, it was almost 12% of the index. It had grown from less than 8% just 2 years prior. And at that point, it was 30 times earnings, despite offering quite little forecast earnings growth, the most expensive bank in the world. Our chief investment officer, Simon Mawhinney, was saying he'd rather stick pins in his eyes than own it at that stage. But other active managers were suddenly being forced to buy it that hadn't held it because they had these 10% maximum underweight limits to benchmark weights. In our view, it's still a very expensive stock. It's at 26 times forward earnings at the end of December. But that example shows you how these kind of concentrations can grow despite what the fundamentals may be telling us. The momentum bias piece is somewhat related to the first two that we've covered, concentration and valuation. As the price of a company rises and it becomes bigger in the index, you're putting more money toward that name with new incremental dollars that's invested in a passive approach, which is really happening en masse. And so over time, you're investing more in the companies that have done well, yesterday's winners, as opposed to yesterday's losers. The companies that underperform become a smaller weight in the index, or perhaps get kicked out altogether. And so you do become a bit more reliant on yesterday's winners continuing to outperform to achieve strong results in the future. That all works fantastically well when the money's flowing in and when the trends continue, but it can leave investors quite exposed if there's a reversal against the trends that have been winning.
It might be like asking to pick your least favorite child, but which of these risks do you see as most underappreciated by investors right now, and why? I mean, I know they're all interrelated, but is there one that sort of stands out more than others in this moment?
I think it's actually a combination of the first two, and that is concentration and valuation. Concentration in and of itself actually isn't that much of an issue. If you're concentrated in things that are attractive investment opportunities, that's what we try and do as active managers. You want to find attractive investments and allocate enough capital to them to make a difference in our investors' lives. I think the issue arises when the concentrations in the market are also things that, at least in our view, are quite expensive. So we've talked about CBA. You also have index heavyweights like Wesfarmers at 33 times earnings, and the Mag 7, which we discussed, are collectively at 35 times forward earnings, far above where they've been historically. And so I think that's the major risk. It's the concentration combined with the valuation risk that I think poses potentially the biggest challenge to forward returns from here.
Chris, a recurring theme has been a shift from the absolute risk, or from absolute risk, I should say, to relative comfort. How do we end up in this world where avoiding underperformance matters more than avoiding permanent capital loss? It seems a bit absurd.
I think we've got here because it's worked so well for so long. Equity markets, both in Australia and globally, have delivered fantastic returns over the past 15 years. It hasn't been in a straight line. We've had things like COVID and the rate rise and Trump's big tariff announcement day. But even the drawdowns have been relatively shallow and relatively short-lived compared to something like the tech wreck in 1999-2000 or the GFC in 2008. I think in Australia, I think it's natural in that environment to start to really think about the risk of falling behind, your relative risk versus the index, rather than absolute risk, the absolute chance of losing money on an investment. In Australia, I think it's been exacerbated by these Your Future, Your Super reforms that came in. That's really driven many of our capital allocators, many of our largest capital allocators, to move toward thinking in a relative sense. If they underperform a passive benchmark by a certain amount over a certain period of time, they're taking on a real business and personal risk. They may have to write to their investors and say, we can no longer accept your money. And as Charlie Munger always says, show me the incentives and I'll show you the outcome. So I think those things are driving behavior, and I think the market has shifted towards far more of a concentration on relative risk and things like tracking error than the absolute risk present in today's markets. At Allan Gray, we don't think in those terms. We're benchmark unaware investors. Our definition of risk is the permanent impairment of capital, actually losing money on an investment. And as we've talked about, I think there's very real risk present in today's benchmarks.
Chris, there's various sources claiming that passive outperforms active, often cited in the media. Particularly the SPIVA scorecard is often trotted out. What's the key mistake you think investors make when they treat those statistics in isolation as proof that active management can't work?
As you said, the SPIVA scorecard is probably the most popular. It has a look at active managers and puts them against a benchmark. It includes the fees they charge, and they come out with the number of managers that outperform the index over time. We wouldn't argue with their methodology. It seems perfectly sound. We wouldn't refute the numbers. For Australia, that number is around 16% of active fund managers that outperform over a 10-year period. So, even your reaction, quite alarming. And I think it's done probably more to drive people towards a passive approach than any other data point or argument in recent decades. Where I think the mistake is often made is in the interpretation. I think a lot of people take that number as their chance of picking a winner, as if they're wearing a blindfold and throwing darts at a dartboard. And that's simply, not the case. They're taking a population level statistic and applying it to their own circumstance. The example I would give here is a medical one. If you have to have a surgery and you're told there's a 10% mortality rate, you immediately think, I've got a 1 in 10 chance of dying. But that's actually not the case. If you're in your early 20s and you're a non-smoker under the care of some of the best surgeons, your chance might be an absolute fraction of 1%, and someone at a different stage with multiple complications might have a very different risk profile. So if we take it back to investing, advisors and investors are not throwing darts at a dartboard in a dark room. They can look at the expertise of the manager, the people managing the money. They can look at the philosophy and how consistently it's been applied over time. They can look at the process, how they manage for risk. And past performance is not necessarily a reliable indicator of future performance, but you can see what they've delivered for their clients historically as part of that kind of overall mosaic. And so I think there is enough there. You also have the work done by the major research houses in Australia that do considerable due diligence. There's a wealth of information out there, and I think there's enough to tilt the odds in an investor's favour if they're looking at the right things and making that decision very carefully. I think it's a worthwhile endeavour.
Chris, would you say that passive investing has effectively become a momentum strategy? I know we touched on it earlier. And if that is the case, what dangers does that pose for investors, and what does it look like if it goes wrong?
I'm not sure I'd go that far. It may not be, it's not momentum in the sense of like a factor momentum quant fund, but I think the benchmarks, because of that market cap design, are biased towards momentum. What does it look like if it goes wrong? I think it might look something like the most recent quarter, Q4 of 2024. We saw some trend reversal, both in Australia and globally last year. So in Australia in Q4, you really saw some of these big index heavyweights that in our view were quite expensive start to come off. Things like CBA, Wesfarmers and Goodman. Globally, you saw value outperform growth in Q4. Last year in Australia, you saw small caps outperform large cap companies, which is definitely against trend of the last 5 or 10 years. And in global markets, you saw emerging markets outperform developed markets by quite a margin. And developed markets have smashed emerging markets over the last 10 years. So very short period of time. We don't know if it will continue, but there has been, a bit of a reversal that we've seen, and it just goes to show what can happen. A lot of those contrarian positions have become smaller and smaller in the index, and therefore a smaller and smaller portion of many people's portfolios. And so when you do see that reversal start to come through, they're not getting the benefit they may have otherwise had, unless they have some diversifying exposures held alongside those major passive benchmarks.
Chris, bit of a loaded question. I think I already know the answer to it, but then an extended question as well. So do you believe investors should abandon passive investing altogether or complement it? And then as an extension of that, when you're talking about contrarian investing as a counterbalance, what role should it play in a diversified portfolio alongside those passive exposures?
Look, I don't think anyone's going to sell out of passive. We've talked about how well it's done, and that's certainly not what we're advocating. We are merely suggesting that now may definitely be the time to consider some diversifying exposures that could be held alongside. The reason that I think a contrarian approach works so well alongside a passive approach as a diversifier is that they're really doing the exact opposite. And we talked about, companies that do well becoming a bigger portion of the index. The contrarian investor is looking at all those companies that have become smaller in the index or perhaps been kicked out altogether. And they're searching amongst those companies for things that have been misunderstood, or there's been an overreaction to the downside. and fundamental value is present. The example I might give from our portfolio is a company called ServiceStream, which was it's engaged in a lot of servicing for infrastructure in Australia for both the private sector and government. It was flying high in 2019 at around $3 and run into some difficulties, some of the ways the contracts were set up, COVID, a lot of things contributed. But it went through, quite a significant share price reduction. It fell, I think, to below $1 by 2021, at which point it was unceremoniously booted from the ASX 200. We started to see fundamental value in the company, and we're buying down around those levels. And over time, the broader market came to see the value that we were seeing in the stock. It eventually got re-included into the index, but by that stage it had rallied to $1.80, and we were able to sell back to those passive investors at that price and move the capital on to another opportunity. There are different ways people could go about bringing in these complementary exposures, or maybe two main ways, I would say. One would be to look at building blocks, or what I'd call building blocks that are available, Australian equity or global equity funds that could be held in a portfolio alongside other exposures to bring in that diversification. Emerging market funds would have a particularly large diversifying impact, because a lot of people are surprised to realize that emerging markets are not in the MSCI World Index. They're in the MSCI All Country World Index, but they're not in MSCI World. And so that would have a particularly large diversifying impact. The other way to go, if they didn't want to touch, their existing portfolio, would be to allocate to a diversified portfolio of contrarian ideas, something like the Allan Gray Australia Balance Fund, held alongside whatever they're doing currently. So, those are some things that perhaps would be worth consideration.
Chris, just by the by, I love that example of ServiceStream. I was actually an analyst back at the time. I remember that journey specifically, but rallying $3 and then collapsing and then it's surging again. So really good example, like I said, of the changing fortunes and being able to adjust to new information, which clearly the team did. Another thing I like, Chris, you frame this passive investing as a modern day siren song. So seductive, but potentially dangerous. So I like that characterization. But if investors are going to take just one lesson from this interview, what discipline do you think they need most to resist that pull over the next decade?
I think the one discipline that we all need to have is to be students of history. We can take lessons of the past to help guide us today. There is a narrative out there that says, the world is moving so quickly, technology is advancing so fast that it's pointless to look in the rear vision mirror. But I think that's a mistake. That the value of a company will always be the present value of the cash flow it generates for us as owners, discounted to today. And I think human emotions will always play a role in markets. Even if a lot of investing decisions come to be made by AI, those LLMs, the large language models, are built on the available information on the internet. So, the very panicked investor or the very excited investor on a Reddit message board is still going to be having an impact on those decisions. My colleagues at our sister company, Orbis, that share our investment philosophy, use this great story that was originally said by David Foster Wallace that I think perfectly encapsulates where we are today. And it's a short one, so bear with me. But essentially, an older fish is swimming past two much younger fish and turns to them and says, "How's the water today, boys?" And he swims on by, and one of the younger fish turns to the other and says, "What the hell is water?" Right? When you're in an environment that lasts for so long, you start to take that environment for granted. You start to extrapolate what's happening today way into the future. And it becomes hard to think about how the world may change and what different states of the investment markets may look like. Today, we've seen growth outperform value by such a huge margin for such an extended period. We've seen US exceptionalism do so well relative to the rest of the world for a long period of time. We've seen those big companies in Australia, the banks, do extremely well for an extended period. Possibly some of those things have changed, but it's just been that very short period we spoke about. And so I think today people do need to be students of history. They need to think about different states of the world and what they could mean in terms of a potential reversal against today's winners. And I think they need to focus on the absolute risk. You know, diversification is not about more assets. It's about assets that behave differently. And I think, you know, it's high time that people think about the absolute risk present in the major benchmarks that are attracting most of the capital, and some ways that they can potentially mitigate some of those risks.
Chris, just by the by, did that story of the fish come from Alec Cutler over
Yeah,
August?
I think so.
Yeah, well, I spoke to Alec not so long ago, and he's always full of great, stories and pieces of advice. So, hardly a surprise that one came from him as well. He's always a fantastic chat. As has this been a great chat as well, Chris. Some really important points, I think, for investors to consider in an environment, as we spoke about at the top, that is being distorted by some pretty significant structural forces. So thank you for taking the time to sit down with Livewire and take us through that. Very much appreciate it.
Thanks so much for having me, Chris. I really enjoyed the conversation.